Most of the Asian markets are trading with losses, but the Japanese indices appear to be bucking the trend.
Markets ended the day mixed as the Nasdaq closed at a fresh record high.
Big move in metals like copper, which has broken out to a new high.
Very, very healthy set of numbers from BL to end FY24 Q4.
There is widespread discomfort among large banks on that 5% general provision which is proposed at the construction phase of the project.
25 lower on the Nifty and about 85 lower on the sensex.
Need now to bigger role play as a strategy. Other vertical also I can be contribute on that.
We are looking at an all-time highs yet again of $2,440 announced on the screens there.
And we're seeing some very, very quiet sideways moves on our market. Again, from those highs, we've come off around 35 odd points. So volatility continues. The VIX is at a 22-month high.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that is the day so far, and it has been, one has to say, a quieter kind of a day. Day on day, there is not very much by way of change, but I have to say also that it's a pretty wild day for individual stocks. It's like the wild, wild west out there with mid-caps and small-cap single stocks really doing a lot. We'll cover a lot of that ground here over the next 60 minutes. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Rima here in the studios, and Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. When you said wild, wild west, when I was looking at some of the metal names, and we'll ask Nigel what's happening. Look at stocks like Hindustan Zinc and the entire pack, ferrous, ferrous. I don't know west or east, but it's definitely going up. The direction today is up on those stocks.
Well, that's right. You know, in the next 10 minutes or so, we'll tell you why. But, you know, Surabhi, we took this call on Bazaar around 45 days or so ago. We said if you believe that this metal cycle is going to be up and going, there's one way of playing it, and that's a high-risk trade. That is Vedanta. You know, because valuations are supportive, the promoters in better shape. And, you know, that's up more than 50% in 45 days. And take a look at Hindustan Zinc. The float is less out there, but the stock has doubled. So as wild as it can get.
Wild, wild west. You know, it is absolutely, you know, gunslingers out there, right? And it's, you know, just to kind of quickly wrap up things here. So market is off the lows by a big amount, 150 odd points off the day's low. Of course, a day on day, as I said, is not very much. Metals and PSUs leading from the front. You know, we'll talk more about this pack as well. Banks are lagging behind. I mean, that's the only thing. That's the only part of the market which needs to pick up. And that, for the Nifty, I mean, so it's kind of cleared all these retracements. And the next level, the all-time high is about 22,800 or so. For the Nifty bank, it's not yet cleared these retracements, the 50 and the 61.8. The big one is 48,832, which needs to clear. That's about 2% away from where we are right now, less than 2% away. And above that, you know, you basically have a line of sight to all-time highs, which the Nifty already does have now. So, you know, it may take some time, and the market may not like to do very much all the way into the election results. But for the Nifty, I think it's pretty clear which way things are headed eventually. Of course, all this is contingent on the fact that on the 4th of June, you know, the market gets what it wants, which is, of course, political continuity. Rima.
Well, at the index level, it's fairly directionless, though we are holding up in the green with about a 40-point gain. Individual sectors, right? Metals with names like Hindalco, Coal India, Tata Steel, JSW Steel. In fact, the top 4 Nifty gainers are all in the metal space. PSUs continue to do well. The Nifty PSC index has a gain of close to about 2%. And in that, it's the broader market. So RVNL 13% up, Hoodco, Cochin Shipyard, SJVN, Ircon. These are all stocks showing you gains of about 8 to 10%. And on the way down, it's FMCG, where some of the profits are being shaved off. It was a big Saturday for Nestle. So Nestle was up 2.5% on Saturday, but today it's down 1.7%. And even names like HUL, ITC are trading in the red.
Okay, well, those are the big boys that are dragging. But, you know, like we've been saying, it's all about metal stocks and, you know, PSU stocks. And if you get a combination of both, then you're seeing even bigger numbers. I mean, Coal India, for instance, it's absolutely breathtaking, the move. It's almost a 5% move today, building on a massive 100% gain in the last 12 months. That's That's a real breathtaking move from Coal India coming through. Then in the broader markets, you have more stocks. I mean, today the reaction on Balkrishna Industries, for instance, is pretty outsized. About 8% higher, 9% higher, even as we speak. Some of the brokers saying that this volume expansion the company has reported in the fourth quarter, 13% volume growth, that's coming after 9 months of a very sluggish performance on volumes, and suddenly this turnaround in Q4, maybe that people are hoping is a sign of things to come. So that's one name that's up and about. But other than that, on the screen, it's just PSUs all the way, from an RVNL to a UCO Bank that's up 6%, to an IRFC that's up 4%, to a BEL. Again, the phenomenal show from the PSU industrial stocks continues. There was, HAL, there was BEML, there's BEL, so that hat trick is on. And we've got some very, very solid numbers coming in, and therefore stock prices rising even higher. But Nigel, yeah, you have to say, it is that move on Hindustan, Zinc, Coal India, all of the stocks that you track so closely. That's what's really taking my breath away today.
Well, that's right. And what's not is the Nifty Bank. That can come to terms at least and even deliver average performance. We'll be on our way to around 23,000 odd. For the Nifty Bank, just one level that I'm tracking out here, the 20 DMA seems to be a bit of a resistance zone. We started off at those levels. We traded above those levels. But in the near term, that 48,300 odd seems to be a bit of a resistance zone. And by the way, for the next 60 minutes, you'll keep an eye out on the Nifty Financial Services Index as well, because that plays out the weekly expiry. That said, let's tell you how to trade the index. We have Rahul Mundar who joins us to fill us in with some closing strategies. Hi, Rahul. Good afternoon. Good to see you in. Well, the markets, ambling some time, waiting for the big election outcome, but we're still holding on. Maybe, in fact, some kind of a time-wise correction may not be such a bad thing. How would you trade the index, and fill us in with your picks?
Good afternoon. I think very well put, Nigel. I think everyone's almost taken the election result as a given. And I think there also is some complacency where, people are expecting that this is the obvious. So I think this is a point in time where one has to not only, trade in the direction of the trend, but also have a plan in terms of keeping clear stops when you are, pre-event waiting for some kind of a strong trajectory to come in. So having said that, I heard your comment on the Nifty Bank, and my take on this is one should utilize the correction in a lot of these stocks as an opportunity. I clearly see that technically, at least, we have a lot of indicators with a medium to long-term horizon still pointing on the upward side. In fact, I'd say we could clearly get past 48,300 and move to levels of 49,600, even if you have a good bit of a time horizon in mind. The Nifty continues to be in fine fettle, in my opinion. We've got a clear barrier that we can see in front of us at 22,600. That's the only hurdle, so to say. Keep a stop below 22,400, and these are spot levels I'm referring to. But coming to even individual stocks, keeping that viewpoint in mind, I'd probably say a stock like Kotak Bank. One could look at, a long entry. The stock's obviously had its share of a beat up in the last couple of weeks. But I think it's a strong, clawback it's making. Could it even head to about 1,800 is what I'm suggesting. And in my opinion, I still see this as a potentially strong stock to enter with the kind of signals, keeping a stop loss below 1,650.
Okay. All right. Good to get that, Rahul. We'll come back to you with more questions, because there are a lot of these big single stocks which are flying around, and we'll want your view there. I just want to make a quick mention of RateGain. I think RateGain numbers just came about 30-40 minutes back. That is a sharp move higher. It's basically shot up about 6% or so on your screen, 6.25. They're absolutely flat going into the results. But look at what is happening there right now, 783. The high, of course, was close to about 900 rupees or so. And from there, it fell to 700 sort of levels. And now it's making a comeback. We'll have the management join us tomorrow morning. And we'll sort of address this one with results and, of course, the outlook forward. But let's come back to the sector of the day, which is metals. And, the industrial metals all rallied, as we highlighted in the morning. But, even steel is doing very well. So let's get the lowdown with Nigel. Nigel, over to you.
All right. Well, let's run you through first the global tailwinds. Why are metal stocks on fire? One is there's hope that inflation is well behaved now. So the Fed goes ahead and cuts rates. The Chinese stimulus continues and various measures are being taken in, both from the central bank out there as well as the policy moves out there. So that's good news. And there's also some supply constraints. For a metal like copper, copper moved up by close to around 5% overnight, and now it's at its highest levels we've seen in more than 2 years at around that $11,000 per ton. There's a short squeeze as well on the trading front, and that's why, in fact, we are seeing a further up move out there. And there's strong demand for some of these metals because of the green push. That could hold them in good stead. So if you're looking at the EV side of things, you're looking at solar panels as well, silver will find some usage out there. And it explains why silver is now at the highest levels we've seen in the last 11 to 12 years odd. Even year to date, actually, silver is outperforming what gold has done. Gold is up roughly around 15%, silver is up nearly around 25% odd. So that's the backdrop, and those are the tailwinds which is helping metal stocks. Let's break this up into three then: Vedanta, Hindustan Zinc, and then the ferrous names. First up on Vedanta, it's a diversified commodity play. If you want to play a little bit of aluminium, zinc, lead, it's got all of it out there. So that's why, that's the diversified commodity play that the street has been working with, and the stock has nearly doubled in the last 2 months or so. When metals does well, then the worries at the promoter end, well, they go on the back burner. And the promoter's in far better shape, and you like that. Now, valuation-wise, even after such a big run, well, the stock trades at around 6 times EV on EBITDA. It's not very, very cheap, but it's not very expensive as well. 6 times EV on EBITDA for a global metal company, well, that's par for the course. Given that the promoter is in better shape, when the promoter is in a bit of a tizzy, then you give it a bit of a discount. So that's about Vedanta. Next is Hindustan Zinc. It's the only listed play on silver. Silver contributes close to around 20% of Hindustan Zinc's revenues. On the EBIT front, it contributes nearly around 45%. And the margins on their silver sales are nearly around 86% because it's a byproduct of their business. So that's why margins are so high out there. And to give you a couple of numbers, silver prices on average for last year was around $24. Currently, it's around $32 per ounce, and we're already just a quarter into this particular financial year. But the point to note is also that the float is very limited. Only 2% of the total free float is in the market. Government of India, Vedanta, as well as LIC, they have 98% in the company. And they are looking at ramping up their silver production as well. So it's the only listed silver play, and that's why that stock has done very, very well. And finally, the ferrous companies. Why are they rallying in today's session as well? Remember, the past quarter was quite weak. But now the street believes that coking coal costs will come down by roughly around $20 to $30 per ton, and steel prices are higher as well. So it's a double whammy in the right direction. Because you have steel prices that are moved up, and you have the input costs that are moved down as well. And that's why Jeffries, that chart should come up for you on the screen. They are saying that they are working with nearly around 2,000 rupees per ton improvement for JSW Steel in the coming year. So put all this together, metals are on fire, base metals as well as ferrous plays. Deepan Mehta is with us. Deepan, well, that's about the metal stocks, not for the faint-hearted, particularly Vedanta, but, risk hai, to ishq hai, right? Tell us, do you like anything over here?
No, I think that metals across the board have been rallying significantly, not just precious metals, bullion, but also copper, zinc, nickel. Across the board, we have seen very strong, even aluminium. From that point of view, I think Hindalco looks interesting. They've also got this Novelis IPO, so that will ease the capital requirements and certainly give them more capital for growth. And overall, I think if the US economy starts to improve and automobile production also looks up over there, then Novelis prospects would be better. But the core aluminum business of Hindalco also should do extremely well because of higher LME prices, which have surged over the past few months or so. And valuation-wise, pretty reasonable. So that's one name which comes to mind. Vedanta, I think still, it's going to surprise on the upside, more so because of the split, and that's going to happen for certainty over the next few months or so. And this entire cloud about the parent company having a lot of debt on its book, that may eventually get settled once and for all if they're able to sell off one or two of the split divisions and reduce debt at the holding company level.
Deepan Mehta is now with us on the show. Deepan, hi. Wanted to get your thoughts in on RateGain. Prashant just alluded to the numbers, and just, to recap the numbers. It's a revenue growth of 40% year on year in the March quarter. Margins have expanded substantially. So from 17.6%, margins are now at 21.2%, and that's driving a 48% jump in the company's profitability. Even for the full year, The company's clocked in a near 70% jump in the company's revenues, and the pipeline looks fairly robust. Now, the
profits for the full year have doubled to 145 crores, which means
70 crores, 68 crores.
On a trailing basis, PE ratio has dropped from 90 to 65. So thank God. I don't know if, but go on. Sorry.
No, just wanted to get your thoughts in on this. It's perhaps it now looks a little less expensive than it earlier did, given the kind of jump that we've seen in the profitability. 112% is the jump in the FY24 profits. But then where does RateGain go from here, and is it a buy?
Yeah, good afternoon, Rima. One more dimension to the valuation. So it did $4 per quarter for the March quarter, and you multiply that by 416. Then I think it is going at around 50 times or so current year or whatever the March quarter annualized earnings. So I think the P multiples certainly are correcting in RateGain, which is excellent because it gives an opportunity for investors to buy into a great business at perhaps reasonable valuation. So this is one stock which we're looking at very, very closely to buy at a correction when you get a P multiple around 35, 40 times or so. At that time, you would have some margin of safety. Business model is fantastic, great operating leverages. And every now and then we keep hearing about them having a tie-up or some new customer which is going to use their platform to access online sales or online booking. And look, they've just about scratched the surface globally. The technology platform is now well tested. Existing customers also are scaling up their engagement. From all points of view, I think it's a very interesting company and certainly should be on the watch list of almost all investors, especially those who want to look for new age concept stocks and have that preference for those kind of businesses. RateGain certainly fits that criteria.
But soon there'll be a company called TBO Tech. It's not directly a competitor, but it's also in a way a play on the travel and tourism. It's an aggregator which helps connect the hotels and airlines to the various consumers, whether it's OTAs, the likes of Ease My Trip, Make My Trip, etc., travel agents. Would you compare the two? Would you say that TBO Tech may look more attractive than RateGain?
So, Rima, I haven't seen TBO Tech, but more the merrier. I think if you have such concept businesses which have got long structural or secular growth stories, those are the ideal investments. If you buy them right, then they can turn out to be great multi-baggers. Although I think RateGain already is a multi-bagger, but from these levels also, if everything falls in place and you buy at the right price, then these companies can go really well. And look, travel tourism is soaring globally. Even it's gone beyond pre-COVID levels. And within India, as well as some of the other developing economies like China and rest of Asian countries, it's really picking up very well. And from that point of view, I think if you want to play the travel and tourism space, then maybe rather than buying airlines or hotels, which are quite capital intensive, kind of a travel and tourism tech company or a tech portal or a platform may be an outperformer within that investment theme.
Okay, all right, got that. Stay on, Deepan. We'll have some more questions for you. We've been talking about some stocks that are doing well. Let's also look at one that's been completely knocked out, and that is Delivery. Clearly, the company hasn't delivered according to investor expectations in the fourth quarter. Stock's down almost 10%. And this after a very lackluster performance. Delivery anyway was nowhere close to the kind of returns that a lot of other mid-caps were giving. And, actually, let's ask Mangalam what the issues are. Mangalam, one thing I noticed is that the loss still continues at the bottom line level, right? What are the other key internals that you looked at?
Well, if you look at Delivery's numbers, it was a seasonally weak quarter. The fourth quarter, not typically the best for e-commerce deliveries, etc., especially coming off the third quarter, which has the festive season. So if you just take a look at, their overall performance, they still manage double-digit growth, and that's because of their part truckload business. And as a result of which, on an operating leverage basis, they saw an EBITDA growth from around 13 crore. The EBITDA jumped all the way to 45 crores. The company continues to report a net loss largely because of depreciation and Q-on-Q weaknesses, of course, on account of seasonality, like I said. Revenue growth of 12%, 2,075 crores, and that because of operating leverage meant an EBITDA jump all the way from 13.5 crores to 46 crores. Of course, this was a big decline quarter on quarter, and the company reported a net profit in the third quarter. But remember, the third quarter is the strongest quarter for Delivery anyway. The net loss came in at around 68 crores. This was a lot lower than what we saw same time last year. The problem point for the company was express parcel business. This typically tracks the growth of the e-commerce revenue in the country, and that grew just about 3% with a volume decline of about 2%. And that is an important main driver for the company in terms of growth going forward, because the largest component of the revenue, which is why the street did not like that. The PTL freight business has actually done extremely well for them, a 27% growth out there with volume growth of 21% as well. And then you had the truckload business, which grew around 59%. Supply chain as well saw revenue growth of around 25%. The company said they've completed a large portion of their planned long-term capital investments, and they've achieved material working capital improvements. So the big trigger for delivery going forward is a pickup in e-commerce deliveries, and secondly, their operating leverage coming back once again. They're also looking to reduce their capex as a proportion of sales by a few hundred basis points, and that would impact their margins going forward as well. But the trigger on the obverse side is the big stake that Masayoshi Son is sitting with. So SoftBank, looking to sell its stake in delivery, keeps a lid on the gains that we see in delivery as well. Additionally, and this was an interesting development that took place, that Sandeep Barasia resigned as chief business officer due to personal reasons. So let's see how much of that is weighing on these numbers. These numbers were weak largely because of the e-commerce vertical, but internals for the company, not particularly bad. In fact, they're only improving.
Okay, take your point on board, Mangalam. Thanks very much. But yeah, as you highlight, I think people can still live with the continuing losses because that's depreciation. But this segment that Mangalam pointed out, express parcel revenue, that is the largest segment, contributing to over 1,200 crores of revenue in Q4 for them. There, the volumes have actually declined by 2%. So that seems to be the biggest pain point that the market is not too happy with. Deepan, hi, good afternoon. What do you think? Like I was saying, delivery, it's not just this quarter. It's last many months, right? Stock has failed to deliver. But what do you think? Is this the time to be patient, bottom fish? What would you do?
Yeah, grounds would be, I think it's best to avoid delivery. Not just that, even TCI Express, you have a look at those numbers also. When it came to express deliveries and, online delivery of goods purchased online, those numbers also are quite disappointing. So I don't know, maybe these companies are not living up to their expectation, which is very surprising because typically you can see that online purchases are shooting up. In my own house, I see so many more parcels coming in almost every day. And, people are ordering so much of so many, goods and so many parcels online. And yet these companies are not able to grow the top line at all. And that's the more disappointing part, because these are long gestation businesses. We understand that, and they take time to kind of get into maturity. But we should have very strong top line growth from companies like TCI Express and Delivery, and that's not happening, and that's a trouble sign. I think it's best to throw in the towel for the time being and exit these companies and look at them when you actually see that they're back into the momentum and you see actual top line growth, which are in about high teens or so. I think until then it's best to avoid.
Yeah, no, absolutely. And the e-com had a pretty tough 2023. I'm not sure what the latest numbers are, but someone was telling me that for some of the largest e-commerce players, growth was in the middling single digits in 23 over 22. And of course, delivery is a e-com sort of proxy in that sense. But we'll see. Deepan, I know Z is a oft-repeated discussed kind of stock, but on Saturday, Z went up, I think it was up 5%. And I think today it's up another 5%. It seems to be just a function of price more than anything else. It fell to 130 last week, back at just about 150 odd rupees or so. Any thoughts here?
No, Prashant, I'm not going to get tempted into buying Z. It's given so many false starts. And I looked at the numbers also, not all that impressive. Z5, which is supposed to be the growth engine, I think it's getting into a structural loss situation. Top line growth was hardly 5%, and still it made a huge loss at the EBITDA level. I'm not sure the numbers. And they're expecting higher pricing, but I don't know how that's going to happen. And that's a business which is getting highly competitive. And Z needs to invest heavily into content over there. It needs to invest heavily into content across the board. But I don't think the balance sheet can support it. On the other hand, its competitors are getting stronger and stronger. And, the merger between Disney and, the TV18 group, that's going to be a big gorilla in this entire market and going to try and shake up the entire industry. And Z doesn't really have a strategy as to how it's going to get across, this increased competitive environment. It's cheap, no doubt about that, and that's what attracts value players from time to time. But I'm not sure it's going to be a great growth story going forward. And you may have trading rallies, which we can see just now on the screens, but I'm not sure they're sustainable.
Dipan, thank you very much for joining us today, and I hope you enjoyed your yoga session on Saturday between the market sessions.
You do remember, Rima. Thank you.
We'll ask Prashant in 3 months if he's started any yoga classes.
Calling you, Deepan. Calling you after this.
Absolutely.
We'll
Looking
check.
forward to your call.
All right, get into a break then. On the other side, Jitendra Gohil from Kotak Alternate Managers is joining in. Stay tuned.
Okay, welcome back. You got the market, which is kind of flatlining now. 30 points is all that the Nifty has got. But today has really not been about the Nifty. Banks, of course, are lagging. It's metals, it's PSUs, and a whole host of single stocks which are really jumping all over the place. Delivery is one of them. On the other side, RateGain is the one which reported numbers, stocks up 5-6%, but there's a lot more which we'll get to. Jitendra Gohil is Chief Investment Strategist at Kotak Alternate Managers. He's with us here to take some questions. Jitendra, great to have you back on the program. Thanks very much. Prashant this side. Just a quick sense in terms of how you're reading the market. And this is a question I've asked a few others as well. Let's assume that everything else remaining same. Market sort of is pretty much at all-time highs. The Nifty is 200-300 points away, you get a decent you get strong numbers for the NDA on the 4th of June. Is the market looking primed for some fast gains from there over the next couple of days, or you think where does that leave us in that sense, Jitendra, near term?
Hi, Prashant. I think it's been quite some time that we haven't interacted. Thank you for inviting me on your show. So first of all, I think the interesting part about India is the fundamentals, macro fundamentals are extremely strong. We think that, yes, market is expecting NDA to form the government and the continuation of policy. That's what market is interested in. And hopefully we see this mandate coming in again, and that might lead to more confidence in India's growth story. But when I look at, apart from political noise, and if I look at purely from a fundamental perspective, I think from a growth side, we might see more surprises, right? So there are a lot of debate whether these numbers to be trusted. But I think we have doing pretty good. Look at the power demand. Look at the PMI numbers. Airline companies, they are doing pretty good. Hotels, even rural side. If I look at the two-wheeler sales, which were languishing, now that have started picking up, and rural demand, as per the FMCG demand, has also started to pick up, and it's growing now faster than the urban side. So net, I think the growth which was lopsided, growth which was mostly investment-led, and now we are seeing slowly, gradually, that is percolating down to the real economy. And that is where I think the interesting part will come up. Now, coming to other factor, if I look at the global perspective as well, when we started the year, market was expecting 6 rate cuts from Federal Reserve. And today we are talking about a 1 or 2 maximum rate cut. And even some analysts are expecting rate can see higher, or rate might go higher from here. But I feel that all this noise, one thing is sure, that the earnings have remained pretty robust. Nifty is trading at 19 to 20 times P ratio, and we have been mentioning this in the past that Nifty can trade even higher valuation. So I'm not very much worried about the valuation part, on the earnings part, on the macro part. But from a sentiment perspective, I think there could be some downturn. But on that basis, we think that it would be a buy on dip kind of a market, unless we see a kind of a major disappointment on 4th of June.
What about FPI selling? Do you see FIs resuming purchases in the Indian markets post the election?
Rima, see, there are a few things that we look at, from FPI perspective. One is the total ownership of FPI is currently around 17 to 18% of BSE 500 companies. And that is at an 11-year low. It used to be somewhere 22%. Now it has gone down to almost 17%, partly because they have sold and partly because the retail and DIs have actually gained share in terms of overall ownership. So that is one aspect. So, and other aspect is our competitors, right? So if I look at China, for example, despite several stimulus to stem their real estate market, I don't see that a pretty convincing reason why one should look at China at this price. Despite all this stimulus, their earnings have remained pretty benign, and also there is this trade tension with the US going on. Recently, they laid a tariff. So I think from market perspective, India's positioning for FPI still remains very strong. And after election, I think once the confidence returns, FPI will have to look at India from a different lenses, as I think we are up for some more surprises in terms of macro. Second, I think in the second half, there is some chance that, look, RBI has been pretty tight in their monetary policies. And if India does not grow at around 7, 8, or even 9%, I would say, will not be creating enough jobs. And hence, I feel that somewhere growth stimulus needs to be there from RBI's perspective. And hence, I think in the second half, we might see even more traction coming in for the equity side.
Hi, Jitendra. Good afternoon and good to see you. And Nigel on this side. That point on China, people still believe that the economic data is not showing up, but there's enough of constraints globally with regard to supply of metals. And that's why there's been a big party out here. We've seen it in the past that sometimes this party doesn't end well, but for the time being, the street believes we've got a couple of years of runway. Are you in the camp? Would you play the metals theme?
Of course, I think this is a strong story that is playing out, and hopefully that continues. So, Nigel, what we have been talking to our investors is like because of ESG, because of constraint in terms of funding, metals mining industry, the capex was benign over the past few years, and now we are seeing the demand is it's strong, while the supply side we are seeing some constraints. Second, all this electric vehicle boom, the new industries which have come up, it needs a lot of copper, it needs a lot of aluminum, it needs a lot of other metals. And hence, I feel that, the prices might remain stronger. The second part to this, outlook is India. Now, India is growing much faster than we would have anticipated in the past, and hence the metal demand has remained very resilient in India. Real estate, for example, the industry has clocked significant sales, right? So one of the largest, real estate company had a pre-sales guidance of just around 15,000 crores of pre-booking. At the end of fiscal year FY24, they clocked somewhere 22,000 crores of sales. Now, this is a significant jump, 60% outperformance in their own guidance. So I think this demand momentum should continue. We have seen that the domestic steel prices have started to firm up and the cost pressures are coming down. And the other thing is the balance sheets. I think look at the steel companies and the metal companies, their balance sheets have improved over a period of time. And hence, I think from fundamental perspective and from a tactical perspective as well, metals mining, including coal and all these companies, we are extremely positive. And remember, these stocks have significant cash flows as well nowadays. So if I look at some of the mining companies in India, the net profit margin, I'm talking about net profit, not an EBITDA margin, somewhere between 15 to even 20%. So I feel that fundamentally they are strong. Dividend yield is good. And in this kind of environment where everything is so expensive, if you're getting metal mining companies where the fundamentals are strong, I feel that it's a good buy, and hence we remain positive here.
Got that, Jitendra. So you're positive on metals. Another area I think that you still like is manufacturing and capex. But let me ask you for some more sort of details over there, because this is a very wide theme. Stocks have also run up a lot, including, of course, capital goods stocks or some of the other themes as well. So how would you play manufacturing from here on? And how are you dealing with valuations, which may seem elevated in some cases?
Yeah, so we bang on. So I think there are a few things that we look at from manufacturing perspective. One is definitely there's a lot of push towards manufacturing, and everyone is recommending today manufacturing, defense, capital goods. But what we have noticed is that some of the companies are actually beating guidance, beating street expectations, right? From margin perspective, it was expected like, look, defense companies are, boring companies. They will not have significant margin expansion. But looking at past 1 year results, if you look at their margins have actually expanded. And also the total addressable opportunities for these companies have improved manifold. For example, let's take defense, right? So if I look in shipbuilding industry, where if I just look at the aircraft carrier, right? So India has 2 aircraft carrier, and now there are talks that we might launch one more, where the order size could be somewhere around 40 to 50,000 crores. So to build one aircraft carrier, government will have to spend 40 to 50,000 crores. And as we grow from a 4 trillion economy to almost 7 or 10 trillion economy in the next decade or so, we will need to spend a lot in terms of our security needs, maritime security. And in that bargain, if we have 1 or 2 or even 3 more aircraft carriers over the next 10, 15 years, I think this is a kind of a structural opportunity. Second, once these orders are given to these companies and they build, these massive warships and aircrafts, then the maintenance comes into picture, and where the maintenance margins are actually doubled, or in fact much higher than the OEM. So I think maintenance is also the recurring kind of cash flow generating opportunities for these defense companies. So we remain positive. We have been very, very positive in terms of aircraft manufacturers for the past several years. And we think that, look, valuation is going to remain elevated. Remember once even FMCG companies were trading at 20 times P ratio, which actually saw upgrades and they started related. They related to almost 60 times P ratio, right? So 3x. Similarly, these companies, defense companies, used to trade in single or low double digit. Now they are trading at 25, 30, or even 40 times P ratios. So I think if the growth comes up, margins remains resilient, visibility is strong, then I think that these segments will actually do better.
And they're also extremely under-owned compared to many of the other sectors. So that's another tailwind for these defense stocks. Thank you, Jitendra, for joining in. We'll slip into a break. On the other side, as always, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also tell you what you can buy today to sell tomorrow. BTST calls.
Welcome back. Well, a few stocks actually should come up for you on the screen. Vascon is a stock that's down close to around 7% as we speak. The numbers are quite disappointing. The management has been guiding that FY25 will be the year to look up to. But for the time being, these numbers are very, very disappointing. Q4 goes down as a disappointment. That's one of the sharpest volume-led losers in the last 1 hour or so. But let's focus on what's going on in D Street. Nimesh joins us to tell us exactly that. Well, Nimesh, a quietish kind of session. But we're trading flattish, consolidating before the big outcome.
So relatively, I mean, I wouldn't say too much of volatile, but there is still volatility in that 100 points band for the Nifty. But the good part is that we're consolidating with a positive buy, so that's a positive thing. I guess no big surprise from the fifth phase has been a bit of a positive thing, and which is why in a lot of momentum stocks, the PSU stocks are buzzing in trade today. Yeah. I guess from a volume point of view, it's a high volume day because there is a lot of institutional participation on both sides. So the flows maybe not be very large on either side, but the gross number may look quite large because the participation is on the high side. That's a broad feedback. I guess metal is a sector we've been talking since morning. The index is up 4%, big rally in a lot of the metal stocks. But apart from that, there is a bit of momentum back in the PSU names as well. So whether it's the rail PSUs or for that matter the defense PSUs, all are buzzing in trade, and that too, I guess in anticipation that maybe the fifth phase was quite strong, and we're heading for a decent number. So that probably seems and explains a bit of momentum in the PSU names. But again, there is a bit of risk factor as well. There are some larger HNIs who wants to play a little safe, and they're not aggressively participating in this upside. So it's a mixed kind of feedback, but from a flow perspective, it's a high volume day.
All right, Nimish, and the point on metals, JSW Steel, they came out with a set of numbers on Saturday. That small trading session, the stock was down 2.5%. And from there, it's bounced back everything. Sale, sometimes you're in doubt. The debt is going too high. For the timing, the street is saying, let's see that later.
Forget everything.
Just buy into the dip.
Momentum.
Stock was down 1.5% in the morning. It's up close to 2% now as we speak. But tell us more. What about individual stocks?
So there are a lot of stocks which are buzzing in the individual names. So the first stock on my list is Aptus Value Housing. That stock is under pressure after a large block. Nearly 7% equity got changed hands. I understand the private equity investor who's part of the promoter entity, they were sellers in today's block, and a couple of mutual funds and some family offices were buyers. So the disclosures could be quite interesting in Aptus Value. The second name is Timken, big mover in that stock after the Q4 numbers, and it has rallied pretty hard as well. But now I understand there's going to be another large block deal very soon. Remember last time the promoter entity sold 8.5% stake at a 14% discount, and it got easily sold out in a single day. So again, there is a buzz that maybe you'll see another large block very soon. The third name is MTA Technologies. That's been buzzing on good volumes. There are buy flows as well. A couple of reasons why the stock is buzzing. One, there is a Motilal Oswal's initiating report as well. They expect a 30% upside from current levels. And I understand the supply from a larger FI seems to be largely over in MTA Technologies. And the last name is Voltam Transformers. It's not a very high liquid stock, thinly traded, but surprisingly, there is an institutional interest in that particular name in today's market, and hence that stock is also buzzing up 4% on some decent volumes.
Okay, all right, Nimesh, thanks very much. By the way, on Timken, are you kind of sort of hearing promoter, another round of promoter selling?
Well, looks like
the parent.
Well, looks like Prashant. That's the kind of indication that I'm picking up. Remember, even last time that Timken Singapore sold 8.5% stake at a 14% discount. So it was well bid at that point in time. But after this rally and big move, need to see how this goes. But again, at least there is an indication that maybe a large block is coming very soon.
Absolutely. Stocks up at about 20% this year already. So that is Timken, 39, 34. Timken, Whirlpool, some of the stocks, MNC names, which have seen some selling from their parent entities. Rahul Mohinder is with us with short-term trading ideas and a quick word on the market as well. Rahul, back to you. What are you picking up and what would you recommend?
I think the first bit is, if you're looking at the index, I think both indices continue to be in positive turf. Nothing that's really changed too much in the last couple of minutes. I still think we are, should be positioned on the buy side for both the indices, as I mentioned, 22,400 to 22,600. That's the band to watch on the Nifty spot. But coming to individual stock names, I would stay away from, initiating a new long trade on the metal names. I agree they've done very well today, but I think we've reached a point of resistance where, we may see a bit of a cool off. I'm not trying to suggest that there's a major down break, etc. coming, but I think we could see a bit of a cool off on some of the metal names, specifically Hindalco and Tata Steel could come under some pressure. So if I was to buy, I would probably look at some of the safer spaces, in my opinion. I talked about Kotak Bank earlier. I think within banking, another stock which I like is Indian Bank. Stock could move to about 610, around 570 is a good buy point. Keep a stop loss below 560. The other two stocks which come to attention, one is Coal India. The stock's done very well. It's broken out key resistance barriers as well. 520 could be a target, 475 a strong support. So keep a stop below that. And if you're trying to look at safer play, I think Infosys is in that range for the last 3 weeks. It made an attempt last week to even get past 1450 and breakout. So some feelers are there in terms of that breakout. So maybe I'm a bit too early on it, but if you can keep a stop loss of 1410, could be a sensible buy at this point. And again, these calls may not necessarily be validated in a one-day innings, but give it a few days and I think we should be in direction.
By the way, lots of buying coming through in PSUs. Pull up an LIC that's up 5.5%. NLC India has moved up close to about 3%. RailTel is now up 5.5%. So these stocks are moving up in the last few minutes. And Hindustan Zinc is now locked in an upper circuit of close to about 20%. So circuit up on Hindustan Zinc. But let's talk about Balkrishna Industries. That's also surging in trade. Strong Q4 numbers. But some brokerages are cautious. Sonia joins in. Sonia?
Well, thanks a lot for that. So, the brokerages have been mixed on Balkrishna Industries. The numbers are very good, no two ways about that. Strong revenue growth, strong volume growth, but a lot of brokerages are mixed. So, let me take you through some of them. 3 out of 4 brokerages on the screen are a bit cautious. So, Kotak has a sell, Citi has a sell, Motilal Oswal has a neutral. But Nomura is the one I want to talk about because they have upgraded the stock to a buy. They have raised their target price to 3,230. Now, they say that the company is now entering a big demand upcycle. They've gained market share in in the India business as well to about 7 to 10%. And there are very healthy demand trends currently, which will enable passing on of higher raw material prices. They also talk about the current valuations at about 15 times FY26 EV to EBITDA is quite on the attractive side. So that is what Nomura has talked about and the reasons why they are very bullish on the stock. But there are some reasons for caution as well. A couple of other brokerages have pointed out the fact that the company has not given any guidance for FY25 is a bit of reason to get cautious. The company has said it's too early to give any guidance because of the geopolitical scenario and how it's evolving. There is some increase in raw material costs as well. The freight costs have also gone up.
However, let's not forget that the Q4 earnings were very strong for Balkrishna Industries. The revenue growth came in at almost 16% year-on-year, while the volume growth was 13% year-on-year, coming in at 82,000 million tons. So strong earnings coming through. Little bit of caution, but some upgrades today by Nomura, etc., is something that has aided the stock. Back to you.
Nuvama has also raised the target price, by the way, on Balkrishna Industry to 3,070. And IFL sees the target all the way above at 3,325. So significant upside, double-digit upside from current levels.
Absolutely. I think for now the street's quite happy with the robust performance and perhaps hoping that's going to be sustaining as we look at this year as well. Thank you for that, Sonia. So that's Balkrishna in focus. Another stock that's reacted very well to numbers today is actually Sudarshan Chemicals. It's been up in double digits for the better part of the day. Now it's up about 8% and this is, of course, largely because of positive numbers and good management commentary as well coming through in the investor presentation. Sonal is here with the key highlights. Sonal.
Well, you know, the numbers were reported on 17th of May, but last night is when the company updated its investor presentation, and there is some positive commentary coming in there as well. Of course, it was the highest ever income from operations in Q4. The company says it was led by healthy growth in domestic sales. Their operating leverage with YOY volume growth this time around is something that led to highest ever EBITDA as well for the company. The export revenues were up just 2% on a YOY basis. The domestic revenues, however, were up 15%. And there was a good sequential recovery in export revenues on a quarter-on-quarter basis, and that is something that the street likes. 23% on a quarter-on-quarter basis. They are seeing improvement in Europe in terms of sales, while the momentum continues in North America as well. Going forward, they are monitoring the crude oil prices and potential impact on any other intermediary prices as well. Not only the P&L, even the balance sheet has improved for the company. The cash conversion cycle has improved to 66 days versus 74 days on a YOY basis. The net debt to equity has reduced to 0.3 times versus 1 times on a YOY basis. And in terms of their domestic market share, it continues to be stable at that 35% mark. Going forward, the company says they are looking at shifting towards higher share of specialty segment and also continue to expand their product portfolio. So good numbers followed by good commentary is something that the street likes.
All right, Sonal, thank you very much for that. So that explains the excitement around Sudarshan Chemicals. We'll take a break on that note, come back on the other side, and we'll have Jay Bala of Cash the Chaos joining in.
Welcome back. Well, the markets, their move actually more or less flattish. Maybe I think pull up the Nifty Financial Services Index. That's the one that could be playing out some weekly expiry today. So the intraday chart should come up for you out there. The Nifty Bank, by the way, is now down 160 points odd. But it's a good time to now shift to politics. My colleague Parishit Luthra sat down with the senior Congress leader, Jairam Ramesh, and spoke to him on a whole host of issues, including the existing GST structure, privatization, and also his views on reviewing the current corporate tax. Let's listen in to that chat.
Private investment is at an all-time low as a proportion of GDP in the last 10 years. The atmosphere of fear and distrust has never prevailed like this as it has prevailed in the last 10 years. The uncertainty in the tax regime, the frequent changes in the GST regime, the income tax regime, these are all sort of trends that we have seen during the Modi regime, whether it's demonetization or whether it's the uncertainty and unpredictability of economic policy. So I was responding to that. Right. And what I was saying is that the India group, the India Alliance, the group, of parties, political parties, are committed to a predictable tax environment in which removal of this fear and distrust is of primary importance. A GST 2.0 is of importance, and the removal and elimination of angel tax and other exploitative tax initiatives is of importance. So that's what I was reacting to.
But Mr. Ramesh, why should businesses believe this pitch? Because when you speak about taxation, it was the retrospective taxation during the UPA era that investors still talk about. In companies like Cain Energy, Vodafone, they had faced the brunt of it. It became a legal hassle globally as
and Cain, which was carried forward, the same Mr. Arun Jaitley who called Vodafone tax terrorism, indulged in that tax terrorism when it came to Cain Energy. So please, let's have the full history of this.
Former Union Minister Veerappa Moily also said that this was something that has hurt the Congress party and the UPA. So how would you assure investors and businesses that those kind of decisions will not be taken?
Well, the best assurance is the performance. I remember on the 13th of May 2004, the results came out. On the 17th of May 2004, which was a Monday, markets fell very significantly. Dr. Manmohan Singh's name was announced as Prime Minister the next day, and markets resumed, coming back to their normal position after a few weeks. And then what happened? For the next 10 years, you had an average growth rate of GDP of 6.8%. You had a private investment rate which was going at about 32-33% of GDP. So that's the reality. The reality was the performance. If you take the GDP growth rate, if you look at the private investment as a proportion of GDP, the 10 years of 2004-2014 was vastly superior to this much hyped period of 2014 and 2024. I'm just now talking about this sector of the economy. I'm not even getting into issues of wages. I'm not getting into unemployment and other issues. I'm just talking of the headline numbers, the GDP growth numbers, significantly higher, 6.8% during the Dr. Manmohan Singh decade versus 5.8% during the Modi decade, and private investment. And a record number of private entrepreneurs taking citizenship of Singapore, Dubai, London, US. Why are they fleeing? They're making the profits here and they're fleeing.
But what about things like corporate tax? Now, this government had reduced corporate tax on existing companies and startups. What's your view on that?
In spite of the very significant drop in corporate tax rates, which took place incidentally a few days before the Howdy Modi event in Houston. Clearly, there was an international audience that the outgoing Prime Minister was playing to. The corporate tax rates were reduced, but private investment has not boomed. There's no buoyancy in private investment. It's still stagnating at about 27 or 28% of GDP. And why are businessmen now going and seeking citizenship of Dubai and Singapore and other countries of the world? They should be investing in this country.
But will you review the decision of corporate tax rate and think about hiking it?
There's no question. We have to have a predictable tax regime. One of the reasons why, Keynes once said that investment is not just a financial decision. Investment is a psychological decision. And today the psychology in India is one of fear, is one of distrust, is one of suspicion. The extraordinary draconian powers that have been given to organizations like the ED, the CBI, the income tax, the small trader, the small businessman, the medium-sized trader, the medium-sized businessman, even big business. I mean, people are afraid to speak. And if they're afraid to speak, they are afraid to invest.
Okay, well, that is Senior Congress Leader Jairam Ramesh in conversation with my colleague Parikshit there. More of that later during the course of the day. The market, I think, is about 6 minutes away from closing. Jai Bala is with us of cashthechaos.com. Jai, good to have you with us here. Thanks very much. So important event ahead, 9 days out. Market holding just under the all-time highs. how are things looking, and what would you trade? Let's get that out of the way first.
Yeah, let's go to the two stocks I have for today. First, again, is a railway stock. I picked Ircon last week, and it's gone to fresh all-time highs. And likewise, I have another one from that space. It's Texmaco Rail, not Texmaco Infra. It's Texmaco Rail. It's breaking out of an inverse head and shoulders pattern, and I'm putting a stop at about 165 and expecting it to cross 240, 250. It's relatively new, fresh breakout. So, I don't know why this has not been touched by marketplace. Probably that's the reason, but it's breaking out of an inverse head and shoulders pattern. Now, that one's an even more interesting pattern, but you need to be a little more patient. We're trying to slightly preempt the market. It's Federal Mogul Govets. It's got a huge pattern taking up on the higher time frame. And if it closes above 422, I think it's got a potential to go to as far as 700. But as I said, it's not yet close above that, but we're anticipating that to happen. So it makes sense for traders to, position size slightly lower because the breakout doesn't occur. And when it comes to the Nifty, it's still holding about critical supports at 21,778 and 21,710. So the least path of resistance is higher. So it's although it's getting really stretched, the momentum is dropping precipitously. You need to be on the long side as long as that critical supports hold.
Jay, afternoon. Anything in the metal space which catches your attention for a trade?
Yeah, we have come very close to a significant resistance of the metals index. I had projected 9,800. It's crossed that in 9,900 and change. But the thing is, COMEX copper is coming to very important, resistance. If it were to drop below the May 20th low of 5.003, I think it's going to see a short-term shock like we saw for silver. I mentioned in April, it saw a 10% drop. Likewise, a similar drop is likely to occur if copper drops below 5.003 on COMEX, the high-grade copper I'm talking about, not the industry producer price copper. So I'm expecting copper to drop somewhere close to 4.65, but higher highs to come through. So we could see a short-term, near-term correction for the metals index because silver is also structured very similar.
Okay. Jay, sort of looking at the trends that we're getting now from banking, I mean, is there any clarity here? Because once again, today is a day when the bank Nifty has been the big drag for the large cap screen. What are the goalposts that you're keeping in mind, and would you initiate a trade at all, either on individual banks or the index itself?
If you want to initiate trades in the banking space, it has to be in the PSU space, but it's more an avoid. As long as the banking index can stay above 46,500 and 45,800, that's the equivalent 21,770, 21,710 for the Nifty. The private banking space is relatively weaker compared to the PSU banking space. And even within the PSU banking space, I think it's just SBI which keeping the market afloat. So be a bit cautious, neutral, wait for the markets to provide direction. Until that point, you can avoid. And definitely private banks are even bigger avoid compared to PSU banks.
Okay, Jay, I think we'll leave it there. A good conversation as always, short one, but thank you very much for your time as always here on CNBC-TV18. Just to sort of wrap up things here, we've got the market which will end absolutely unchanged. The Nifty will end about 8 points higher, but you'll have the sensex which actually will end down about 100 odd points or so. I think that's the rate which was coming through. Yeah, I mean, 0.14%, 0.15% lower, but the sensex is down. You've got the Nifty Bank, which is lower, I think was lagging from the word go, and I think that is down more meaningfully, 0.4% down at almost 48,000. And mid and small caps, market breadth is negative. Some 1,500 stocks lower, 1,000 stocks up, and broader markets, mid and small caps, up on your screen has got about 1/3% higher on the mid cap and 0.5% lower on the small cap index. But metals and PSUs really two pockets where we saw the bulk of the activity.
Well, those were the two dominant themes, metals and PSUs. So in the metals, Hindalco, Coal India, Tata Steel, JSW Steel. These top four commodity names sum up the top four Nifty gainers. For Hindalco, it was a gain as much as close to about 5%. And outside of that, Hindustan Zinc, Vedanta also saw significant buying. and PSUs, and I think individual result reactions, right, all over.
Really, yeah, they were dominating. I mean, I'll just name some PSUs. RVNL, SJVN, outsized gains over here, double-digit gains on these stocks, almost 14% on an RVNL. BEL's, Bharat Electronics, its earnings were very well received by the market, 6% up over there. A lot of the PSU banks have had a good session today, especially the second half of the session. So UCO Bank, Central Bank of India, these are gains. IOB, these are gains between 3, 4, 5%, depending on which stock you're looking at. So PSUs remained a very, very dominant theme. As we're ending off, I mean, some of the smaller names which also managed to catch the eye. You've got, of course, Vedanta, like we were discussing, because of the overall metals rally. Polycab has had a good close today. InfoEdge, 3% higher, decent volumes as well. So overall, you've got a pretty buzzing mid-cap screen. But yes, for the large caps, the banks remained a problem. And the net result now is just about a 7-point up move on the Nifty.
Well, with that, it's a wrap and closing bell. Don't go anywhere. Markets Forward comes up next.